Hi, and welcome to this week's market presentation. Latest news. Starting with the latest developments, President Trump has ratcheted up pressure on Russia, threatening secondary tariffs on those countries that are still importing Russian oil. The tariff level has been stated from as low as 100% to as much as 500% on those countries' exports to the US. Currently, India is one of the world's largest importer of Russian oil, with Russian supplies accounting for roughly 35% of India's oil consumption. Additionally, Russian crude oil supplies roughly 10% of global demand for oil. And so the prospect of countries, especially India, turning away from Russian crude in order to avoid these potential tariffs could send shockwaves through the market that increase the price level of crude oil into the triple digits. Then moving on to the US economy, there are growing signs that the US economy is slowing down. The July jobs report released by the Bureau of Labor Statistics last week not only showed underwhelming job growth in July, with 73,000 jobs compared to expectations of a little over 100,000 new jobs added, but had significant downward reductions in the job growth seen in May and in June. Overall, those downward revisions total just under 260,000 fewer jobs than previously reported. This would be the worst 3-month period of job growth in the US economy since the onset of the pandemic. It will certainly add more pressure on the Federal Reserve to move ahead with interest rate cuts at their next meeting. Weather. Moving on to the weather forecast, we know temperatures in Europe, which had been milder over the previous week, seeing an expectation of higher temperatures once again, particularly as we move through the middle of this week and through the beginning of next week, with above average temperatures across most of Europe. In terms of precipitation, we see limited forecasted precipitation over the next 7 to 10 days, although the Nordic region is still expected to see some rain, particularly at the beginning of this week. Lastly, in terms of wind speed, following an uptick in average wind speeds, which helped the wind power generation outlook, wind speeds over the next 7 to 10 days are still expected to remain slightly on the lower end. Lastly, looking at the Atlantic hurricane outlook, after a pretty uneventful start to the hurricane season this year, we're seeing additional activity with a tropical storm there in the Atlantic called Dexter, and more importantly, chance of a 46% likelihood of another tropical storm or cyclone forming there in the Atlantic. Important to keep an eye out, particularly if those end up shifting closer to the Gulf of Mexico, which could end up impacting US LNG export activity. Macroeconomics. PMI figures were released for the month of July for most of the countries seen here. And most notably, we see a slowdown in the manufacturing PMI in the US, decreasing by 3.1 points to below the 50-point level, likely as a result of the introduced tariffs hurting the US manufacturing industrial sector. Over in the euro area, we see a relatively stable evolution so far, with limited monthly changes in both the manufacturing and in the service sector. Nonetheless, looking at the service PMIs, we do see a further improvement on the US side of things, with a further increase to a PMI level of 55.2, helping sustain the US economy. Lastly, looking at China, we also see a similar stability there, particularly in the manufacturing side of things, although on the service sector, we are seeing a slight decrease over the past month. Crude oil and LPG. Moving on to global crude oil markets, here we note a slight uptick in the price level, with prices for the front month moving up just under 3% for both WTI and Brent. The increase in the price of oil likely driven by still strong demand expectations in the coming weeks due to weather conditions both in Europe and in Asia. And then looking further ahead, we see a slight upside for 2026 oil prices. So far, we are not seeing markets price in a potential removal of Russian crude oil from markets in the case that countries decide to avoid purchasing Russian crude, and still a relatively stable price evolution over the past week. Natural gas. In terms of natural gas prices in Europe last week saw upward movement, particularly at the beginning and middle of the week, before easing off slightly at the end of last week. Overall, prices for the front quarter for TTF rose 2.5%, with the front year seeing a similar increase of 2.3% on the week. The upward movement, particularly at the beginning and middle of the week, was in part driven by the still relatively lower storage levels in Europe. Storage levels ended at the end of last week at just under 70% full, which corresponds to roughly 7 percentage points lower than the past 5-year average and 17% lower than last year. Looking at the injection rate over the past week, we did see a slight improvement, largely owing to the slightly milder weather conditions, which helped reduce overall gas consumption and helped improve the injections into storage. As we move through this week and into next week, with those higher temperatures being forecasted, we could see injection rates come down over the next week. Nonetheless, we are seeing a continued improvement in the deficit versus the previous year, owing to slightly higher injection rates than the last year, but nonetheless, we're still significantly behind. Nonetheless, analysts are still estimating that at current pace of injections, the more flexible storage targets across the EU for this year will still be met. In terms of the country level storage levels, we want to highlight Germany at just 62%, roughly 8 percentage points below the European average of 70, and a greater cause of concern given their large storage capacities relative to other countries. In terms of the total supply and demand, we see that decrease in total demand largely driven by weather conditions turning more favorable, while total supply has remained relatively stable over the past week. In terms of the supply mix, we've seen that further improvement in Norwegian gas flows, with flows at the end of last week reaching roughly 340 million cubic meters per day. On the other hand, we've continued to see a decrease in LNG send-outs week over week, as well as a decrease in overall LNG imports into Europe in July versus the previous month. One of the factors reducing the level of LNG imports into Europe is more fierce price competition with Asian consumers. In particular, the higher and hotter temperatures that we're seeing across Northeast Asia is leading to greater demand for natural gas. And as a result, we are seeing a higher premium on Asian LNG imports versus those of Europe, potentially unlikely leading to some diversion of cargoes away from Europe and towards Asia. Coal. In terms of coal prices, we note a slight uptick in European coal prices, a similar increase as with natural gas. Part of that increase is certainly the uptick in gas prices and the competitiveness between coal and gas. One other factor is that over the last few weeks, coal stocks at ARA terminals have remained at roughly 2.9 million tons, which compares to 4.9 million ton storage level last year, indicating that relatively lower storage levels we have this year so far, which could also indicate additional demand to shore up storage levels ahead of the winter in the coming months. Over in Asia, we're seeing less upward pressure on coal prices. Part of the reason is that Indian coal stocks are roughly 20% higher year over year, reducing their demand for new imports. And then over in China, while we're seeing a decrease in domestic production to compensate for the overproduction that we've seen so far this year, we are seeing a slightly lower level of import demand currently. EU and UK emission allowances. Looking at emission allowances, we see a pretty stable price evolution over the past week, similar to what we're seeing particularly across gas markets as well, with more limited upward or downward movement. In terms of the emission level, we've seen that sharp drop over the past week, very much driven by one, the slightly cooler temperatures resulting in lower power sector consumption of fossil fuels, and also an improvement in the renewable generation outlook, as well as the share of nuclear, which is overall reducing emissions from the power sector. Electricity. Moving on to electricity markets, we see a very similar price evolution as with natural gas, with prices increasing particularly through early and the middle of last week, with a slight decrease at the end of last week. Overall, prices have increased roughly 1.6% for both the remainder of 2025 and also for the front year. Looking at the price evolution across other European markets, we see a similar evolution with a similar trend of increasing prices through the early and middle of last week, with a slight decrease at the end of the week. Over in the Nordic region, we are seeing a more clear upward price evolution across the area, and a driver of that is the hydrological deficit that we see there over the last few weeks, raising some concerns over the hydropower outlook in the region. Moving on to European total demand and residual load, we see that decrease in both over the past week, both pushing to the lower end of the range since 2019, very much driven by the ongoing weather conditions. In terms of the supply mix, we note that improvement in the nuclear power share over the last 100 days, very much driven by the increase in output from the French nuclear fleet. We can also highlight the improvement in renewables, particularly as we see that for a continued increase in the share of solar and that beginning of an uptick for wind power generation. On the other hand, the high temperatures during the summer have also led to an increase in demand for both gas and coal-fired power generation. Looking at nuclear power generation, we see levels near the top of the range over the past 5 years and currently in line with the levels we saw last year. Looking at the share, the production of renewable generation, we see that increase over the past week now to the highest levels we have had, and noticeably higher than the same point last year. At the same time, that has led to a corresponding drop in the share of fossil fuel and the output for fossil generation, pushing it to the lowest level since at least 2019. The increase in renewable power generation has primarily been driven by that sharp uptick in wind power output as weather conditions have improved. On the other hand, that has also led to a decrease and poorer performance for solar power generation, now with output in line with last year's despite the capacity additions over the course of last year. In terms of fossil fuels, we note that sharp decrease in fossil gas and hard coal generation over the past week, very much due to the lower demand levels across Europe and that uptick in renewables, reducing demand for gas and coal-fired power generation. Lastly, looking at the guarantees of origin, we note that for 2025, a year of production, we see further decreases over the past week with an overall decrease of around 5.3%. Looking further ahead, particularly for 2026 and 2027, we see more upside in the price level over the past week. In the shorter term, the overall improvement and increase in total renewable power output, certainly adding to that bearish pressure that we've seen over the past week, with the increase in expected demand for guarantees of origin moving forward, and some of the concerns, particularly regarding the outlook for hydropower generation in the second half of the year, adding to that slight uptick in the price level over the past week. That covers this week's market presentation. Thank you for joining.